Welcome to the Stock Spinoff Investing Podcast, where we talk all things spinoffs. My guests and I may maintain a position in the securities that we discuss today, and this podcast is for informational purposes only and should not be relied upon as investment advice. Hi, everybody, and welcome to the Stock Spinoff Investing Podcast. I'm your host, Rich Howe, and I'm excited to have Colin King from Circle City Capital back on the podcast. Colin, welcome.
Hey, Rich. Thanks for having me again.
Yeah, I think this is your third time you've been on the podcast. I think you're going to be double digits pretty soon. It's fun to just talk with you every once in a while because we just look at and invest in the same stuff. So I subscribe to your newsletter and you've been publishing some really good stuff. And so there are three names that I wanted to talk to you about today. All current spinoffs, upcoming spinoffs, or past spinoffs. And so I appreciate you making some time today to come on.
Yeah. Yeah, you got a good list to cover. Let's hit it.
Awesome. Yeah. So what I was thinking is that we could talk about NCR Atleos, which is an interesting spinoff from a couple years ago. And then we could hit Aumovio, which is Continental spinoff, European spinoff, which has been trading for a month or so. I think is pretty interesting. And then I was thinking that we could talk about Honeywell's upcoming Solstice spinoff, its advanced materials spinoff, with which, pending the government shutdown, it's supposed to take place, and regular way trading is supposed to take place on October 30th, and
Yeah,
when issue trading is already taking place. So maybe we should start with NCR
I like that order.
Atleos.
That's like my order of interest in each of those anyway. So that's perfect. Let's do it.
Amazing. And so I guess this I cover I wrote a deep dive on this one, when it went public in 2023. It was spun off from the NCR Corporation, and it looked like an ATM, pure play company. And the thought process was this is a big, heavily levered, highly levered company tied to ATMs, and the use of cash is going down. And
Yeah.
so like
Secular decline. Yeah.
secular
Yeah.
decline. And my thought was like, pairing leverage with industries in secular decline is, not really a good playbook for investing in spinoffs. So like I wasn't that excited about it initially. But then Alta Fox came out with a write-up, and it started trading. I should have followed it a little bit more closely. It kind of turned around, and the business started to turn around. And then Alta Fox published a great write-up. Stock jumped a little bit. Then they reported earnings. Stock jumped a ton. And so I've finally gotten around to doing more work on it. But I would love to kind of get your, high level thoughts, what you think is interesting about the company, and we can
Yeah.
just go back and forth.
I did the same thing. I looked at it when they did the Voyix spin and the Atleos spin. I really wasn't that excited about it at the time. I feel like NCR is just one of those companies that's always traded at a low multiple, and people for whatever reason just haven't really respected the company, and they've always had that aspect of, oh well, ATM is in decline, and they did the big self checkout hardware and stuff, which is a really lumpy, not super exciting business. So I took a look at it and just kind of passed on both Voyix and Atleos, but kept it on my radar. And then I think maybe it was like a year later, Diebold came out of bankruptcy, and I looked at that, and that was really interesting and traded also insanely cheap for how much debt they had wiped off, but it was still mostly hardware, and Atleos had more of a service mix. So I can't remember what caught my eye. I was maybe just flipping through, or maybe even saw something on Twitter where they were talking about doing $6 a share in EPS. And at the time when I started looking at it, it was maybe $30. I was like, oh my gosh, that's pretty interesting. So, projecting $6 in a couple of years. So I just looked through a couple transcripts, and I saw this comment from the CEO, and he was like, yeah, I think don't hold me to the actual numbers. Just with my holdco stuff, I'm like in and out of the public markets for like 1 or 2 or 3 weeks at a time. Um, but the CEO said something like, "Oh yeah, we're over the next 6 quarters, we're going to do $600 million of free cash," and it was like a $2.5 billion company. And I was like, "Oh my gosh!" So he's talking about what are we going to do with this? Well, we're definitely not going to do a dividend. We're about to hit our leverage target here in 1 or 2 quarters, if I remember right. So that just kind of sparked the interest to take a closer look. Then when I unpacked it, it was a cheap stock, expecting to grow EPS by 20% a year, or maybe more, depending on how they deploy cash over the next few years. And you just don't see companies trading at, 6, 7, 8 times earnings, growing EPS at 20%. And they had a pretty legit path to get there. So I think those were the like series of events that led me to that name.
And do you own this one?
I don't own this one.
Yep.
Like the minute I published my write up on it and started looking at it, the Altifox write up came out and I was like, ah,
Yep.
crap. And the stock went from, I can't remember, $30 to 38, 39, maybe $40 immediately. And so I just have been, I don't know, it's a stupid reason not to buy it, but I just have been like watching it for a little while since then.
It's really interesting though because you often see this where the Fox write-up came out, it jumped a little bit, and then they reported earnings and it jumped a ton. But then
Yeah.
it's just been sitting there and it's just been kind of fading. And I think it's all people like you and me who are like, oh, this looks interesting at a high level, like company trading mid-single digit earnings multiple, growing earnings 20%, like on a peg basis, that's crazy. But
Yeah,
it's like just getting around, and I'm finally getting around to doing my work to being like, okay, did I miss it? I don't think I did. So it's kind of an interesting pattern in the market. And one thing that I saw you post, I forget what company you posted on about on Twitter recently, but you said, I love charts that look like this. And it was basically a chart and it was showing the earnings going up. I think it was
yeah,
overlaid the stock chart. And I don't know what company that was, but generally, if earnings are going to go up, usually the stock will follow, right? Even if
for
it's a little bit
sure.
lagged. And so it seems like that's the case here, right?
Yeah,
With
I think that's
NCR
spot
Atleos.
on. And I think maybe the next sort of big catalyst for this one is just them to start. So they're really close to hitting their leverage target. I can't remember if that's, maybe 2 and 3/4 or under 3x, whatever. So they're about to be in a position where they can start using cash for things other than just delevering the balance sheet. And I think that's probably the next thing that gets this going is maybe more of a firm plan on here's what we plan to do with all this cash flow over the next 2, 3 years. But you're right. I love those. It was EEFT, which is Euronet, which is actually a comp, like kind of a comp. It's a money transfer business with some ATMs in their network. So it's sort of a comp to NCR. But yeah, like if the fundamentals are increasing over time and you have valuation or the share price flat, like that's a pretty interesting setup, right? Because people are just not giving them credit for the improved fundamentals. And I think that's what we're potentially looking at here.
It's funny that you mentioned that. So the name of the company was, what is it? EFT.
Yeah, it's Euronet Worldwide. Yeah.
So I was pulling up a comp sheet, a comp table for this, and that came up, and that was the only name that looked unjustifiably cheap. And it like dragged the comps down. And so that
Yeah.
it looks like it's like revenue's growing, earnings growing. Why is this thing so cheap? Maybe it's just like the euro name that like
It's more of
the
an international business than like Brinks or Diebold, which to me, if you're making the secular argument for NCR, it's interesting that Brinks, BCO, and Diebold, DBD wouldn't have the same backdrop for that, right? Because those are
right.
definitely trading at higher valuations than NCR. But maybe the EEFT thing is just more international. I can't remember. Maybe they've got some more debt or something like that. But all comps for NCR are trading at higher valuations than where it's at. So you've got
Yep.
growing earnings, free cash flow about or free cash flow is growing and it's cheap on a free cash flow basis, but you've got capital allocation about to inflect to something more flexible than it has been in the past. Like that's kind of a nice backdrop for a 2 or 3 year stretch, right? It's a name that you could hold for like 3 years and just let it go to work.
And I think their leverage target is like 3 times. Is that
Yeah,
right?
I think that sounds right. Yeah,
So
I think
why
that
is it
sounds
so
right.
high? Like you would assume that they would try to get a little bit lower, but like 3 times seems decently high. You're comfortable with that though?
Generally, I kind of like to instead of taking debt to EBITDA, I like to look and see how much debt they have relative to the free cash that they're generating.
Hmm.
So
Hmm.
like, it strips out some of the add backs and other things that they're doing and looks at it just purely based on cash generation. And I like to see 6x or better on that, right? So if you deployed all of your free cash to repay debt, 6 years to do it, I just think that's a little more conservative metric than debt to EBITDA, and they're comfortably within that. It's a high cash generation business, right? So it's not as lumpy as it once was. And they actually have, so the whole thesis is this ATM as a service, right? So they used to just sell the hardware, offer the software and the services for the ATM itself to the bank. And now they're trying to grab more of a larger outsourced pie of what the banks are doing to manage the whole ATM process, basically the money management process, other than the delivery, like the trucks that Brinks does. So they can go to the bank and basically pitch 30+% cost savings for them to take this stuff on. And it's more revenue and higher margin and less lumpy than their old model of sell the hardware with a maintenance contract behind it. Like that's pretty compelling. So they don't need their installed base to grow at all. They just need to take a larger portion of their installed base and put it on this ATM as a service package to win. Like that's the play in a nutshell. Like I kind of like that. Like it's all self within their control, self-help.
100%. And then, so I was looking at the ATM as a service, and it's still like relatively, maybe it's like hundreds of millions of dollars, but it's
Yeah.
still relatively small at this point. Like, have you thought about how big that could get?
Yeah, they gave you you're right, it's small, but it's growing really fast and
Yeah,
has
like
way higher.
30%, I think. Or
Yeah,
I think they said on the last call like 100% backlog.
that's right. That's right. So it's growing quick and has better margins than their core business. I haven't done, well, sorry, it's been a minute since I've done the back of the napkin math,
Yeah.
but I'm just kind of looking at my write-up now. They
Yep.
had This was from their 2023 Investor Day, from the spin. They had a 600K installed base of ATMs. 18K were under this ATM as a service, you a structure or a revenue model, and their goal was to get that to 125K of ATM as a service with no change in the entire installed base. So 18K to 125K. And I think that 125K is what is their $6 plus EPS goal is built off of.
Got it. Got it. That's really helpful. Yeah, I was going back and looking at the Investor Day slide deck, and it's the estimates were optimistic. Like it would they were guiding to like 6 to 7% CAGR, and it's like that the spin guidance is always sometimes optimistic. But that's really interesting. Okay, I'll go back and look at that.
Yeah.
And then I guess my other question is like, is that sustainable? So like that's the key question, right? Like, okay, maybe they can get to $6 in earnings, but is it, do you think it's sustainable in terms of, the ATMs that are installed and their service contracts and their maintenance contracts? Like, do you think does the business begin to shrink at some point?
So I think what's interesting is if the ATM as a service is really as lucrative as they say, and the cost
Hmm.
savings to the bank are real, think about this for a minute, right? So 600K installed base in 23, and they're guiding, or sorry, during their investor day, they guided to 600K installed base in 27. So no change in installed base. So all of their revenue and earnings targets are purely and simply driven by this mix shift to this new product. So they're going from 3%, 3% mix for ATM as a service in 2023 and projecting that to be 20% of their mix in 27 for that. So really, I mean, that's pretty fascinating. So you can actually have maybe 100K or 200K of your installed base goes away at some point. But if they keep ratcheting that mix higher over the next, this is just for 3 years, right? But take that 5, 10 years into the future, they could perhaps continue growing both earnings and revenue just by changing their mix shift. And oh, by the way, they are going to the banks and pitching that this new service will save them money, like from their current setup overall. Like that's pretty fascinating. So you almost don't need, maybe the market will never give them full credit from a multiple standpoint because of the overall industry, right? But they're sort of in control of their own destiny for perhaps 5, 10+ years. I think that's
Yeah.
what's most interesting about it.
Yeah, and then five in that case, if they're in control of their own destiny for 10 years, then like a 6 times earnings multiple doesn't make sense.
Right, exactly. So maybe 125K or whatever ATM as a service target for 27, take that to 200, then 300, right? Forget the installed base, the total pie. Just think about that one number and where it could ultimately get. Like that's what's probably going to drive earnings in this thing for quite some time.
And then I think they already have like a $200 million share repurchase authorization. Is that about right?
Yeah, yeah. I don't know if they've executed on that yet,
Yep.
but you're right. They did put that out there. Yeah. So maybe it's
And,
like, starting to get some momentum on the capital allocation front.
I mean, I think that's the other big thing. It's like, we don't know what the catalyst is, but the catalyst could be just like aggressive share buybacks.
Yeah,
Right.
absolutely. I mean, if they, I think they were saying, oh, man, I wish I knew the numbers off the top of my head. I want to say on the last call, the CEO said something like $400 million of free cash in
Mhm.
2026. And if I remember, this thing is still like a $2.8 billion company, something like that. Like, holy cow. Yeah. You just
Right.
put all that to work and there's no dividend, right? And if they're not planning to take down debt, I don't think acquisitions are going to be part of the play, which I like, right? I prefer that they're not going to look at M&A. I don't know, maybe they could scoop up some more ATMs or something, but it's more of an organic growth story. So all that free 400 million probably going to go to buybacks at this price, I would imagine.
Yeah, that's compelling. That's very compelling. Okay, so he said, I'll go back and look at the transcript, but you said you seem to think he said like 400 to 500 million of free cash flow next year.
I want to say that was their 2026 target.
Yep.
Check my math though. Check my math.
I will. Yeah, I will. Okay. Well, this one looks really interesting. I'm going to be doing some more work on this one, so I appreciate all the insight and the knowledge.
Yeah.
Anything else to add before we move on to Amovio?
No, just NCR, cheap, 20% earnings growth. Um, Probably a multi-year runway to do that, which it's
Dude,
nice
why
to
don't you
not.
own it? Why don't you
I
own
know,
it?
I know.
Listen to
I'm
this
kind of like
pitch.
talking to myself into it.
Yeah,
I might by the end of the day.
yeah,
Yeah,
exactly. Well, okay, great. So this is really helpful. That's a great summary on NCR. Let's move on to Amovio. So just to set the stage, so Continental, which is I guess primarily, I guess it was an auto parts business, and then they
yeah,
also have a tire business. They spun off their auto parts business, which was in a bit of a turnaround mode, and this spinoff took place in I think about maybe a month ago or so. And
yeah.
we're recording this podcast in late October. I think it happened in September, early September.
That's right.
But yeah, to you, what's kind of interesting about Amovio?
Yeah, Aumovio to me, and I own shares of this one.
Yep.
I've been buying the ADRs at a little bit below $8 a share. I kind of think of it as a little bit of a trade. I don't know that it's a great business that I want to own for 2, 3, 4 years. Um, but you're right, it's an automotive parts spinoff, and they have a couple different divisions, so there's not like a perfect comp for it, right? Like each of their different segments that they're in is kind of comped to different parts of the automotive supply chain. Um, it's insanely cheap. I mean, it's like trading at 2 times EBITDA or something like that.
No
And
debt.
and no debt and a huge pile of cash, right? Huge pile of cash. And so they put it in a position where, how do I want to phrase it? I've told myself anytime a spinoff comes with an abnormal industry balance sheet, like I got to take a look, right? So two of my biggest spinoff winners were Sandoz, generic pharmaceuticals, and Finia, the automotive
Mhm.
parts spin. Both of those came out with significantly better balance sheets than industry average. Like Sandoz and generics had 2x leverage and was growing. Peers were at like 4x levered and insanely cheap. And Finia was the same way, like best in class balance sheet. So Armovio net cash in automotive parts is pretty unusual, right? And so what they're grappling with though is the business, many pieces of the business are in turnaround mode and the fundamentals aren't amazing to begin with, right? Like it's a pretty low margin company. So they're doing some restructuring and stuff. And you know, I don't think their overall economy is doing that great. So even though they left it with this big pile of cash, I don't think they're going to come out and do like a big buyback or do M&A or do anything like that. Like the messaging that I read when looking at it was we want to sit with this clean balance sheet as we work through this restructuring plan and achieve the target margins that we're looking at. So I think you're going to be sitting on like this stale balance sheet, so to speak, for the next 12 months. I don't love that, but at the same time, like in a tough market where people are worried about recession and all sorts of other stuff going on in the market in general, like I like that they have a really defensible balance sheet. And then 12 months from now or a couple quarters from now, as they get around this restructuring plan, then perhaps they'll start putting that cash to use, right? With maybe either a large dividend, buyback, whatever, that to me would be the catalyst. So it's kind of a little wonky situation, and the foreign aspect of it, like they're not as, I don't know, they're not as on top of, here's the strategy, here's where we're going, here's what we're gonna do. So I don't love it as a 5-year bet, but it's insanely cheap. Like whatever you have as a notion of cheap, it's like cheaper than that. And they have this insanely clean balance sheet. I think that's enough to get me, comfortable with a small position.
Yeah, 100%. I mean, even if you, so they have a net pension obligation of $1.5 billion dollars, and even if you assume that's debt, they still have a zero
Yeah,
debt balance sheet because they have 1.5 billion of cash. And
correct.
even so, if you, yeah, take a conservative approach, like on an EV to EBIT or EV to revenue basis, it's
It's
absurdly cheap.
still, and the pension thing, they're profitable with the pension cost baked in, one.
Mhm.
And then two, if you're going to comp it to other peers, you need to adjust peers for their pension obligations as well, right? So I look at that and I say, yeah, I hear everybody on the pension thing, but like you got to take those two other pieces into account as well.
Makes complete sense. And
Yeah.
then the other thing that's kind of interesting too is that if you look at their businesses, so they have safety and motion, user experience, architecture and network solutions, and autonomous mobility. And then if you look at the underlying EBIT margins for some of these businesses, they're negative, which is kind of a good thing because it's like, hey, can you get this to positive? Like for instance, their autonomous mobility, which is
Yeah.
17% of sales, is a negative 1.4% EBIT margin in 2024. Either that gets to be profitable or they get rid of it, they shut it down. The user experience business,
Also
it,
sucks.
same thing, right? So
Yeah.
it's like it's like spin off those businesses again, right? Or just
Yeah.
shut those businesses down, and then the stock's even cheaper than you think.
Yeah, I had that thought too. It's that same idea of there are multiple comps in here, right? And yeah, the autonomous segment is a money loser. And actually their two core businesses, the ANS and the safety business, if I remember, are like 10% plus EBITDA margin businesses. So pretty comparable to what you would see for US peers that would actually get like a 5 to 7x EBITDA multiple, maybe. And then they have these two other segments that just kind of suck right now, but they're really bullish on the autonomous thing. And so I don't know. I guess they'll likely hold on to that. But you're right. They
Yeah, and
have
I'm okay.
they have
I'm okay with them holding on to it, right?
yeah.
Because it's 2 3 years down the road, if it still hasn't come into fruition, um, you can do something about it or sell
I,
it or
I
spin it off.
yeah, I think that's what I like about it is with the balance sheet, with the clean balance sheet plus these four different, very different businesses, you've got a lot of options to make this thing work over a 2 or 3 year time frame, right? So either those lower margin, negative margin businesses get up to par and they contribute to earnings and earnings grow and you still have the cash, or maybe you kind of split this thing further into smaller chunks of company that are still pretty large. I mean, these are still pretty big slugs of revenue for each of these things. So I like that optionality here.
And then one thing, so I was going to ask you, said it whenever spinoff comes out with an abnormal balance sheet versus the industry, I want to take a look. And my next question was going to be why, and you already explained why. I've recently gone back and looked at all like this spinoff academic research and industry research, and one of the big takeaways from a couple of the pieces was that lower leverage spinoffs outperform. So it's
Oh yeah.
that's kind of consistent with with what you found. And then GE Vernova is another example of a stock with net cash balance sheet, and it's painful to bring up because I missed that one, but
Well, it also went into like full meme stock mode, right? Like I missed that one
100%.
too, but it also just went like,
There's so
okay,
there's
come on,
actually there's an ETF. There's a GE Vernova 2X levered ETF. So it's like I'm like, okay, well, it's
can't
hard to
kick
predict
yourself
that.
too hard. Yeah,
But
absolutely.
another thing about GE Vernova that GE Vernova had is they had the wind division, kind of similar to Aumovio, was losing money, but is going to get to be break even.
Coming back. Yeah.
Yep.
Yeah. Yeah. So I think that's what I like about it. I tell myself, like, give it a couple quarters, see what they say, let them get through this restructuring. I mean, they just spun, so they haven't even reported a quarter yet, right? So it's also the most dangerous time to invest in spins, in my opinion, where like you get the real results as they come out with the carve out numbers and the guide. Like any company that messes up the guide from a spin standpoint, like the stock is just hosed, right? If you get that wrong. So I want to give this a few quarters, see how it plays out, see what they say. And then ultimately, if they don't have any clarity on what they're going to do with the cash or where they're headed within maybe 3 quarters from now, then I may just move on. But I like the optionality in a market where people are complaining about, high multiples, high valuations, hard to find good ideas. Like, I don't know. This one seems pretty easy.
Makes complete sense. And then a lot of times you can see, say you want to invest in a company and you want to see like 100% upside. Usually that company's going to be highly levered because it's like you just go from a 6 to an 8 times EBITDA multiple and you get a
Yeah,
double. But with
that's
this
all you
one,
got to
you
do.
could, yeah, you could double. It could be a double without, and it is no debt. So it's definitely
Yeah.
a pretty unique from that perspective.
Yeah, I think that's right. I think that's right. So I don't know. I think it's not a huge position for me. I mean, it's also foreign. I don't own a whole lot of foreign companies. But I want to see what they say in the next couple of quarters as results come out.
That makes complete sense.
Yeah.
Okay, let's move on to the third idea that we are going to talk about today, which is an upcoming spin-off. Honeywell is spinning off Solstice, which is its advanced materials business, and I know you did a nice write-up on it, but maybe just talk about how you see it, whether you think it's interesting, how you're thinking about this upcoming situation. It should start trading on October 30th. That's the day of regular way trading, 2025. But if the government shutdown continues, maybe none of these spin-offs I think they'll all get pushed out to mid-November. But yeah, so what do you think about Solstice?
Yeah, this is the Honeywell three-way breakup, and I feel like those multiple spin situations have all historically done pretty well, right? When companies do the massive breakup. So this is the specialty chem portion within Honeywell. Um, I there's things I like about it. There's things that I don't like about it. I can't imagine it's going to be very cheap, and it's sort of like one of my thresholds of I'm still just sort of a plain vanilla value investor looking for cheap stocks with a catalyst or something unique about them. So Honeywell trades at, I don't know, north of 14 times EBITDA in aggregate, right? And if this is going to be a best in class specialty chem business, like great balance sheet, 25% consolidated EBITDA margins, I can't imagine it won't trade at sort of the top end of specialty chem valuation, somewhere in like the 10 to 14x EBITDA range. But they've got a couple of pretty good businesses, right? They do the refrigerant chemicals, which has regulatory demand to it, and then a big piece is tied to semiconductors. I actually don't know that I love that. I know it sounds sort of dumb, but if the semiconductor demand doesn't hold up, or it isn't what people expect it to be, like 3 4 years down the road, then I don't know. I don't want to buy into the growth story if it doesn't wind up continuing, right? If there's overspend in capex there, and then people have to pull back. So yeah, the semiconductor piece is expected to be kind of the growth engine. The refrigerant business is like a 40% EBITDA margin business, so like just insanely good economics and valuable. But it's a high capex business, right? So they spend like, I don't know, I'm looking at my notes right now, 8 or 9% of revenue on capex, which is pretty high even for a specialty chemical business. And they're trying to add capacity now, so they expect to ramp that over the next 2 years or so. So I don't imagine there'll be any excess free cash, but leverage is only what, a turn and a half or so. So I would imagine they'll look to still crank that up and do M&A. They've talked about getting into M&A. Granted, they've never done M&A in this segment, in the history of this segment, since 2016. So it's like, okay, we're getting into M&A, but we haven't done it before. Hopefully that goes well, right? Um, so I don't know. There's a whole bunch of dynamics at play. I'm gonna wait and see how it trades when it comes out. Um, but I'm not getting my hopes up too much just yet. It looks like a good business. It looks like a quality business with a good balance sheet. I just can't imagine it's gonna come into my zone of interest. I don't know. What do you think about it?
Yeah, I mean, all these industrial spin-offs, they just never get cheap enough to get me that excited. And I just got to take off my value investor hat and just like buy them if they're cheap on a relative basis versus their comp set, because it seems like a lot of them have done very well. So
Yeah.
like I'm hoping, for some selling pressure, which I think we will see, but it probably won't get cheap enough for me to get really excited about it. From like a high level perspective, just like looking at the spin-off academic research. So typically spin-offs that come from a division, like a conglomerate that has three or more divisions, those tend to be better opportunities. Companies that have industry average or lower net debt to EBITDA, which Solstice will have,
Yep.
tend
Yep.
tend tend to do pretty well. And then companies, it's interestingly companies that make are acquisitive, tend to do pretty well. But I agree with you. It's like they come from the Honeywell culture, so they have that M&A blueprint, but at the same time they haven't really done M&A in this division. So a little bit of a risk. I guess the mitigant there is that they're going to be doing just bolt-on acquisitions. So I don't think they're going to be doing anything that's too transformative. From my perspective, I guess I have one concern that I have, and I need to talk to the company about it, and I'm curious if you have any thoughts on it, is their refrigerants margins are just so high. And it's like, why are they so high? And it's like, well, they have patents. Like they have I think like 5,000 patents. And so they have patent protection for something called R1234YF, which is I think they're the main refrigerant in that division. And I think it's attractive versus what else is on the market due to environmental concerns that this is more environmentally friendly than the legacy refrigerants that are on the market. And so I've tried to look into kind of the patent, like when could there be issues if patents expire and competitors can come in,
Hmm.
and I haven't really been able to get a good answer on that in terms of like when there's one patent that's going to expire and the portfolio is going to be at risk. And then the other thing that I think is just interesting, and I'd be curious to get your thoughts on one or either, is just the margin guidance. So as you know, as well as I do, that initial guidance is very important, and you got to hit that guidance, or else, especially if you have a lot of debt, which Solstice doesn't, you're going to get crushed. So they're guiding to adjusted EBITDA margins of 25% or higher, or basically
Hmm.
25%.
Yeah. Basically 950 million EBITDA, right? Yeah.
Exactly, exactly. But if you just look at their year to date, and I think that Honeywell actually reported earnings today, so I got to look at the segment results for this business. I think margins were like 29.9% adjusted EBITDA margins. And then if you assume, so basically implied in that guidance is that there's going to be $200 million of dyssynergies. But then if you look at the Form 10 and you look at the guidance for recurring expenses as well as the TSA, where they're going to reimburse Honeywell for a period of time, only gets up to like $140 million
Huh.
of recurring expenses. So I guess I don't know if Solstice is being conservative there, or if I guess I'm not too worried about them missing their adjusted EBITDA guidance, because I think that number is either realistic or it's conservative. But
Yeah.
I'm
It's a
curious.
refreshing take on a on a spin situation, right? Oh, come out and actually set realistic goals coming out of the
Right,
spin. Yeah.
right,
I
exactly.
Yeah, I think that makes sense. And I just to come back to your margin comment, I
Yep.
think it's just an insanely niche portion of the chemical business. Like Chemours, CC, they've got a competing business, right? They make Freon, and they've got another product that has a branded name that's not like a random jumble of letters and numbers. And I want to say that's a close to a 40% EBITDA margin business as well. They might have more corporate history that you could go back further in time and see how stable have those margins been. I haven't looked at that, but I probably should if I wind up owning this. And then Ingevity, NGVT, they have an insanely niche emissions chemical business that has like 50% EBITDA margins with almost no capex in it. My guess is the refrigerant business for Solstice probably has virtually no capex compared to the other side of their company, and it's likely the best piece of this overall business. I don't know from a growth standpoint, but economics are probably the best. So some of those really, really niche portions of specialty chem, I think they're out there. This is probably just one of those. I don't know how sustainable it is. The thing that I thought caught my eye that was maybe a red flag a little bit they have this chart of their revenue from 2016 to the 2025 guide, right? Or 2017, maybe, essentially when this division was created inside of Honeywell. And it was basically like 4 years of flat revenue. Then revenue stepped up, and then it's like 3.5 years to 4 years of flat revenue again. So it's like flat, step, flat. um, it really doesn't paint the picture of this like consistent growth business, you know? And I think that's what they're trying to message this thing as. So I guess I'm maybe a little bit more skeptical on the idea that this is just going to be a steady Eddie, consistent, I think they're guiding to like low to mid single digit revenue growth over time. Um, my guess is it's not going to be that quite that clean from a revenue standpoint. So revenue's
Yeah,
flat, expected to be flat this year, right? Yeah.
yeah, exactly. I completely agree with that. And I listened to the analyst day, and an analyst asked that question, and they said, it wasn't a great answer, but they said just basic demand was crazy for refrigerants coming out of COVID. They were like, people couldn't buy enough air conditioners, and so they were
Yeah.
like, that was the big driver. And then the other thing that they mentioned was that, to your point about semiconductors, is like 2022, there was a big I think 2022, 2023 was like a big downdraft in semiconductor demand. And so I think that also negatively impacted the business. But yeah, it's not like a steady Eddie grower, like, oh, 2 or 3 or 4% every year. It's just like you have that big kind of jump and then kind of flattish growth. So I think, yeah, I agree. I'm assuming 2% revenue growth
Yeah.
next year is kind of what I'm thinking.
So that I think that's what scares me, right? So if you've got like the open AIs and NVIDIAs of the world that are just driving this insane amount of CapEx and OpEx in that space right now, and the chemical side of it is just way, way, way downstream of all that. It's sort
Hmm.
of like a
Hmm.
picks and shovels into that, I suppose.
Hmm.
Um, you could get yo-yoed along the way, right? If you get 2 years in and they're like, crap, we got to throttle back all this data center capex, semiconductor capex, and spend, then I don't know, you could be staring at a situation where you've got nice growth, and then a big chunk of it just kind of falls away as those orders dry up. So I don't know. I'm I'm not saying it's a risk, right? This cycle is likely to go on a lot longer than I'm imagining, but I do think it's cyclical, right? Like I don't think you should just
Definitely.
assume, you know, AI is going to make the capex cycle run forever in this space. So I don't know.
Yeah, I totally agree. Okay, so let's talk kind of valuation, what you're thinking. So, Honeywell's going to spin off 100% of the business. So there's going to be four shares, one share distributed for every four shares of Honeywell. So my sense is that, so, so I think there's going to be about 159 million shares outstanding. Um,
Yep.
I think my fair value estimate on an equity value basis is maybe a little bit higher than yours. It's like maybe 9.5 billion to 10.5 billion, with kind of a fair value range of kind of 60 to 66. I think you're a little bit lower, right? Are you kind of more in the
Yeah.
50
T- I,
$50 range?
I said I basically said, hey, if it's 950 to 1 billion in EBITDA, and that
Hmm.
whether that's 2025 or 2026, I mean, it's October, right? So at some point, all of these valuation estimates are going to start tipping toward what do people expect to happen in 2026, right?
Right.
So if it's $1 billion in EBITDA, call it 10 to 11 times is 53 to $60 a share is what I put on it. And the reason I
Hmm.
came down a little bit from that uh, higher end EBITDA multiple, I just don't think this is a huge cash converting business. So
Hmm.
if you were to go put a 12, 13x EBITDA multiple on this, you're probably paying an insane free cash multiple, even normalized, right? So forget the elevated capex. I think you're probably paying a pretty rich free cash multiple. So I don't know. Maybe I set that target as more like this is where I think realistically it should be, even though it may not be. That's how I was thinking about it.
No, I think that makes sense. And I think one other thing that I'm assuming for next year they do, I think you're assuming 950 million of EBITDA, and I'm assuming 988 million of EBITDA. And I think the way that I'm thinking about that is I think I'm assuming 25.5% adjusted EBITDA margins, because I just, my sense is
Mm,
that the guidance is a
they're
little bit
sandbagging.
low.
Yeah.
And then the TSAs are going to roll off, and then they're going to get a little bit of revenue growth, but like, TBD. I don't
You're
know.
right.
That's
You're right.
yeah,
You're right. And then CapEx will be abnormally high anyway, so they kind of get a pass from a free cash standpoint, most likely for the next 2 years or so. I'm imagining 25, 26, maybe part of 27, they'll be spending more on some of these growth projects. So I don't know. I looked at it and said if you've got $1 billion in EBITDA, 120-ish million in interest, 25% taxes, call it 8% of revenue is CapEx, then you're probably looking at 400 million of free cash, which is $2.50 a share on 159 million. So 250 a share. I don't know. Even at $60, I was like, oh man, that's just not necessarily my cup of tea. But we'll see. We'll see what it winds up doing.
yeah, 100%. It's amazing what these free cash flow multiples for some of these industrials trade at.
Yeah,
It's
but the flip side is that Honeywell is going to be insanely more cash generative, right? Without this, I
right,
think,
right.
I think when I did the math, Honeywell is shedding like 14% of their operating cash flow, but almost 30% of their CapEx is going away as part of the spin. Like, holy crap. So it's going to get way more asset light as part of the spin. I almost always do work on the RemainCo because people tend to forget that you can create a good RemainCo situation in looking at spins, but I haven't yet done any of the work on RemainCo Honeywell and what the future breakup looks like there. So that is on my to-do list at some point.
Yeah, I know you got to run soon because you have something at the top of the hour, so we'll wrap it up soon. But yeah, I've looked at Honeywell RemainCo, and I think if you comp them to the automation and especially the aerospace peers, those guys trade at really rich multiples.
Mm-hmm.
So like I think um, GE I think trades at like 32 or 35 times EBIT. And so
Jeez.
if you assume those kind of multiples, then like RemainCo is definitely undervalued. But like
Yeah.
and this is the curse of the value investor, it's like it's very hard for me, even despite the secular growth outlook, me to like, my favorite setups are like it's cheap on an absolute basis, and if you do the sum of the parts analysis,
Yeah.
it's dirt cheap, right?
Yeah.
When I have to assume like a 35% EBIT multiple, to buy something, it's hard for me to do.
Yeah, you're not getting excited about 35 times EBIT? Like, oh, that's a hard relative bet to make, you know?
Yeah.
Um, the someone commented on my write-up on this to take a look at the DuPont spin because
Hmm.
they have
Hmm.
some overlap from the semiconductor product standpoint. Have you done any work on that? I mean, DuPont, I looked was trading at like 11x EBITDA pre-spin consolidated. So they don't have the refrigerant business obviously in their chemical spin, but I haven't done enough work on that one yet to see if either the RemainCo or SpinCo on DuPont's interesting yet. Have you looked at that one yet?
So that one, I think is more heavily tied. I think they're more heavily tied towards towards like the semiconductors, semiconductor growth, and I think a lot of their materials are used. They're used in the semiconductor manufacturing process. So I
Yeah,
think, but they're not. I'm like, why hasn't growth been
good.
insane? Yeah, and I think it's because they serve the entire semiconductor market instead of just like focusing on the high performance AI chips.
Yeah.
But in the semiconductor market has been kind of in a since 2022. I think it's been kind of I think in 2022 was the year that it big pullback. But
Yeah.
I think the expected growth for that one is more like 6 to 7% organic sales growth, which seems attractive. I think they're guiding to like high single digit adjusted EBITDA growth, a little bit higher leverage. I think it's like 3 times net debt to EBITDA.
Hmm.
Yeah, so that one, I think that one looks interesting again. It'll be just depend on where it trades.
Yeah. Yeah. At some point I'll take a look at that and see if maybe the RemainCo gets interesting as part of that. If they shed some debt, shed some CapEx, and then shed that higher growth business, maybe people get more excited about that than what's left over. So okay, I'll take a look at that one.
Awesome. Well, Colin, this was really fun as always. Really appreciate you coming on. And yeah, any final thoughts, or I guess where can people? You've been on a couple times, but for those who haven't listened to prior episodes, where can they find out more about you and read your work?
Yeah, absolutely. And thanks for having me. Always love talking stocks. I think my parting message is there's still really good, cheap companies out there. I actually am preferring companies with clean balance sheets or companies that are selling stuff at good
Mhm.
multiples and delevering so they've got more optionality heading into the next 2 or 3 years. So Leggett and Platt, I really like that right now. Leggett LEG. You can find me Value Don't Lie on Twitter. And my email is Colin at circlecitycapitalgroup.com, COLIN. Yeah, happy to chat anytime for anyone who wants to reach out.
Awesome. Really appreciate it, Colin. We'll
Yeah,
talk soon.
thanks, Rich. Appreciate you having me.